Hello and welcome to another episode of Freight to the Point, a podcast from Zen Cargo. I'm Helena Wood, and today we have another special episode where we feature one of the recorded sessions from our virtual summit Navigate, which we last held back in October. The session featured today was entitled 2023, It's Time to Take Action, with Zen Cargo's CEO and co-founder Alex Hersham and Chantal McRoberts, the head of advisory at Drewry Shipping Consultants. In their session, Chantal and Alex covered what has happened in the market, how shippers should navigate contracting season for 2023, and why businesses should not forget about origin management amidst the falling freight rates.
Welcome, Chantal, and welcome back to Navigate, everyone. I'm delighted to be joined by Chantal McRoberts, who's the head of advisory at Drewry. Chantal has over 20 years of experience in the maritime and shipping industries. She started off working at P&O, which I recently found out where she was the youngest ever trade manager, which is a really fun fact. Now, Chantal was modest and said it was for a backhaul trade, but I think backhaul trades are really the lifeblood of how businesses work. And Chantal's worked at some other startups like APL and Maersk, so it's very au fait with the in and outs of how shipping lines work. And Chantal's going to be talking to us about what's happening in the market, how we as a community and you as shippers can prepare for 2023 tender season. And I think importantly, we'll also be talking to us about what does it mean to be a shipper of choice in today's market? And is that relevant in today's market? I think it is very relevant, but Chantal will be telling us more. Welcome, Chantal.
Hi, nice to meet everybody. Hope you're all well.
I'm sure they are, and I'm sure they're very much looking forward to hearing less of me and more of you. So I'm going to jump right in, if that's okay. This is probably the obvious starting question, but the market is moving very, very quickly. Tell me how your clients are keeping up with these changes.
So as we're seeing, the market is constantly evolving and our clients are desperately trying to keep up and desperately trying to future-proof. We're immediately seeing three approaches. On the operational side, obviously with the current slowdown in shipment volumes and demand, and with full warehouses in North America and Europe, we see our clients are adjusting their shipping volumes and trying to identify where best to keep inventory and to avoid overwhelming networks. They're also going through the process of destocking. Obviously, the warehouses are full, in the middle of all the disruption when it was move. Now it's clear. Another approach is now we're seeing, which is very closely linked to that, is we're seeing that our shipping community communicating more frequently with their providers, primarily to set lower expectations on volume, of course, linked to the combination of reduced demand and the destocking issue that's continuing to happen right now. From a contractual point of view, we now see both sides trying to find a compromise on the volume commitments, which aren't being reached, versus retaining cargo, which is available to ship. We know that providers and ocean carriers are desperate to fill up the capacity, but we also know that some shippers now just don't have the volume. We also know that some BCOs are starting to work on their new contract negotiation strategies already because of the way the market is evolving and to take advantage of an improved bargaining power in the forthcoming contract negotiations. In our view, contract negotiations will no longer be about capacity and allocation. It will be very much strategic and about what rates are acceptable to the shippers in the market. So lots going on and lots of things that they're trying to do.
Really lots there and lots to digest. We're going to come on to the 2023 tender season and what you're seeing with some of the large players and how the wider audience can read into that in a moment. And we'll also talk about this concept of being shipper of choice and the relevance in today's market. But you touched on there a few things. What's without going into any details, what are you seeing where dead freight deals have been signed? Is there any room for negotiation there, or if a dead freight deal has been signed, it's been signed?
Well, that's a really good question, and it's something that we're being asked quite regularly at the moment. Our advice at the moment is to go back to your contracts, try and leverage your provider relationship, revisit the terms, try to talk about, what would be an acceptable level on the MQC versus the dead freight, and talk about sort of this whole sort of the right approach in developing this sort of two-way relationship. I know we're going to talk about the shipper of choice, but when we're in a market which is sort of in a bit of a tailspin, it's now important to be a carrier of choice. So if the providers want to be that, to retain the volume at an acceptable freight rate, then maybe they need to start opening up and talking about the removal of the dead freight clauses.
And do you see any carriers trying to merge that conversation into a 2023 conversation? Obviously, some dead freights are multi-year anyway.
Yeah.
But is that happening? So are we sort of having 2023 negotiations almost happening by accident already because of that type of dead freight contract renegotiation, or not?
I would say it's a sort of a slightly hybrid, because obviously anyone who's got, if you're on the Transpac calendar, you still have your rates valid until April of next year. So there is a conversation happening now which will set the tone for those conversations with the next boilerplate agreements or master service agreements. So it's a hybrid conversation where, we would always say, go back, speak to your providers, leverage your relationship, be open with them about what you can provide and what you can't provide and why that's happening, and then try and talk to them about, how does that impact the contract? How does that impact my MQC or my dead freight clause? And then bring it back to the table when you come into your bid season.
But just before we get on to 2023, you've mentioned destocking a few times and the volume that's available. We did some analysis that showed that in previous cycles, destocking typically lasts 3 quarters. Mm-hmm. And actually, I would say that some verticals have been thinking about this and clearing inventory levels since much earlier in the year. Others might just be starting to think about it, but some verticals have been aware of this and been taking action really since April or May. How should people be thinking about destocking, which then means less demand and easier to negotiate with carriers, versus an eventual, well, you can only destock for so long? Should people really be thinking about destocking patterns, and maybe the carriers have more strength next year if we move back into a normalized environment? Or is that the wrong way to be thinking about things?
I think you have to put it in the context of where you think the market's going to go. In our opinion, we think the industry is entering a period of managed decline. So capacity management will be key to determining what the freight levels are and where do they bottom out and where do they normalize. So that destocking conversation fits within that. Obviously, that is happening right now, but we know there's a weaker outlook for demand. So when you put the combination of those together, even if we hit a point where people need to then rebuild inventory, demand is lower and consumer spending is lower. So therefore, the volumes will therefore be lower, which means the capacity available will be higher, which then again drives down that supply-demand balance. So it really is thinking about the context of the market, where it might go the rest of this year and where it might go next year, and how both of those things fit into this.
That's really interesting. So let's talk a bit about the 2023 tender season. How should people be thinking about timing? When are the large players moving? And just talk about when people should be thinking about running their process as well, given all of these very fast moving dynamics that you've mentioned.
Yes, so we would definitely say right now, track what the market's doing. As I said, I've referred to the market being in a tailspin. We see, the spot rates, I think they are on a 31 weeks of reductions now. So we all know that 7 months of decline, we know that's happening. So if you are in the position where your rates expire at the end of the year, you might want to think about extending your rates until March to see what happens with the market. And again, that gets you through Chinese New Year. Shorter term contracts, some people have spoken about, they become much more transactional. But again, in a falling market, that might be to your advantage. You might want to think about reducing your volume commitment, or you might want to be thinking about going to 6-month contracts. What we're saying for the Transpac calendar is get ready now, prepare, monitor, and then go to bid in early 2023 like you would, but expect to do 3 rounds. We're running bids right now, and we are seeing significant differences between round 1 and round 2. And that is all because the carriers know that latent capacity is coming back into the market, and they can see the spot rate decline at the same time. So it really is picking your moment, having the knowledge to hand, And then really think about renegotiating rather than going to the spot market. We would always advise that. We always say long-term relationships are better. However, you need to leverage those relationships to try and even secure rate reductions right now. We know some carriers, not all, are going to larger BCOs and saying, look, we know your contract rates are higher than the market. We know the market is falling. What can we do? How can we work together? And there is that conversation about, again, retaining volume over at a proportionate rate level that still allows them to make sufficient profit, which they're totally used to doing right now.
And I think that point of relationships are important is a really apt point. And I'm going to come on now to this sort of question around being shipper of choice. But I think if we look to the last 24 months, and I know not everyone has acted in the same way, but actually relationships have been very vital, whichever way we look at it, whether it's allocation, whether it was equipment release, whether it was getting even being offered at the beginning of the sort of crisis, even being offered a long-term deal was seen as preferential. So I totally agree with that. You have spoken, though, many times about being shipper of choice, the importance of choosing the right shipping line. Talk to us about the relevance of that, given the backdrop of this falling market.
So in our opinion, and you know, obviously people may differ on that, we still see the shipper of choice communication approach to be relevant. Everything now is about relationship, and it will still be in the future. Okay, the rates might fall, capacity may come in, but we know the carriers will take action to manage that capacity. So if you have a better relationship with your carrier or your freight forwarder, if there is a cancelled sailing to control the capacity in the market, then at least you will be at the front of that. If you stop having those conversations and you go down the route of being purely transactional and demanding the lowest rate because you know the market is moved down, then effectively, operationally, you could be impacted. We believe the approach promotes proactive communication. It highlights why the shippers are a good customer to the carriers. But actually now what I would say is the carriers need to adopt some of that philosophy to show why they would be a partner of choice. So I think the conversation will slightly change and the mix will slightly change. And hopefully as well, the forwarders will have more of a voice. They'll be less stuck in the middle. They'll be able to also leverage their relationships as well. So we will have our shipper of choice, our direct ocean carrier of choice, and then maybe our forwarder of choice as well. You know, again, it is about collaboration. There's bigger subjects than freight rates probably on the horizon. So things like sustainability, carbon neutral shipping, they all require a relationship to understand how everybody is going to calculate that and how it will be used to make decisions. So that's why this term shipper of choice continues to be important and will continue to shape how the industry evolves.
So I actually really agree with that. And I think I obviously definitely agree with freight forwarder of choice. Let's start with that. But I also really agree with shipper of choice and knowing who you want to do business with. Some shipping lines are more flexible and more supportive and more relationship oriented. Some prefer data. Some are okay with, let's say, more volatile or transactional relationships. I think that's really important. And I think despite the fact that we might look back over the last 18 to 24 months and say, well, rates have been high, maybe now it's our turn type dynamic, I think having relationships through the cycle is vital and it really helps businesses perform. Just before you joined, Helena was saying that there was a poll done and people are still expecting a lot of uncertainty and lots of volatility. And again, if you can build those ties and deepen those relationships across the ecosystem, I think that helps you navigate and buffer through those periods of uncertainty quite effectively.
Absolutely, I would 100% agree with that. And it is the volatility and the disruptions and the disruptors where the relationships really help you, for the want of a better expression, navigate through those. And if you don't have that and you're purely on a transactional basis, then often you will find that your cargo suffers the most in those disruptive situations.
Well, all we have to do is look back to a period not too long ago when there was a Suez Canal blockage with the Ever Given. And I remember the days and weeks before that it really did feel like the market was coming down. I don't know if you recall, but it really felt like the term market was getting back down to a 3 or even a 2 handle. You could feel it getting to a elevated, but only marginally elevated level. And then obviously that completely changed the game. and sustained very, very high levels for the sort of following 12 months, really. And I'm not saying that was the only thing that drove it, but if we think about that in the context of it was one thing that acted as a big catalyst to change structurally the outlook, again, I think it speaks to the importance of relationships and the importance of both sides of the table delivering on what they said they were going to deliver on. Talk to me for a little bit about origin management, because I know that this is a service that Drewry have been offering recently. And at Zen Cargo, just for context, we think that purchase order management is key. We think that if you do purchase order management well, the SKU visibility that it gives you is so powerful for your merchandising colleagues. The ability to drive down origin dwell times, which is one of the key KPIs I actually look at on a daily basis in terms of how we operate our business, is hugely impacted by doing purchase order management. Consolidation and reducing the amount of air freight, all impacted by great PO management that for us flows through our systems where we have the network on platform. But you've been speaking to me a lot about origin management and how Drewry think about origin management. So perhaps maybe I can start with, why have you recently started to offer services around origin management?
So this is an evolving service or solution, and it has come about because we saw a need for shippers to either refresh their existing origin management program or actually start one from scratch. It has been forgotten because of all the disruption. Everybody became focused on the freight rates, focused on the total spend of ocean freight. And as we were talking to our clients, primarily when we're running bids for them or even to our benchmarking community, we realized that there were a lot of issues with their origin management providers. So we started to think about this and sort of brainstorm, and we realized that we could help bring recommendations of process optimization to include the flow of information and the desk level processes between the source, the factory, i.e. the origin management provider, the origin management provider subcontractors, and then the destination custom brokers and shippers. So again, this sort of micro supply chain within the origin management process really needs some work doing on it for a lot of shippers. We can also help recommend alternative options for the cost structure. Again, purchase orders and things like that. And, the management process and the carrier management processes, they're also interlinked. So, we really thought, okay, we can give some strategic theoretical advice. Obviously, we can't go in and set this all up, but we can help guide those organizations that either need a refresh or those who do not know even how to start. And I think those are the people that need the most help. But I think this is something that as the ocean freight market stabilizes, hopefully will become a greater focus because it is a cost leakage point within the supply chain.
Yeah, I think it's a cost leakage point. I also just continue to believe that it's one of the biggest strategic levers that, if done well, can impact the entire downstream.
Absolutely.
Obviously doing things at destination to manage destination dwell, to manage prioritization of intake, to understand if there's been service disruptions and what that means for intake are all hugely important. But we started Zen Cargo really with the belief that purchase order management, when done well, is a game changer. And only a few businesses globally do it well, and the impact that can have. We even see, actually, if I talk a bit about what I see in the market, we even see such a big divergence in how people manage origin dwell. So everybody wants to focus on the origin dwell KPI. Rarely, unless you're working with businesses like Zen Cargo, do you actually have accurate data. Because typically the manufacturer might say it was the freight forwarder, the manufacturer, the shipping line might jump in as well. So there's always this sort of that dynamic. But also it's so interesting how people manage their origin in different ways. Some are happier to have longer cash to cash cycles and flow everything through a CFS, even if it doesn't need to flow through a CFS. So they have more control over their intake and they store more at origin. Others are more about lead times and processing. And if you can find utilization improvements, then that's great, but never crush the lead times. So it's really, I think there's so much value across origin management, and maybe there's some people out there that we can work on, we can support together, you through sort of the consultancy service and us through the ongoing order management. And I think that would be a lot of fun.
Yes.
I'm conscious of time, and I know that I'll be browbeaten into sort of making sure that we move through. So just a couple of last quick fire questions to you. The first one: is the market going to stabilize?
Is the market going to stabilise? Well, that is the key question that everybody's asking. Obviously, we know the rate decreases are being driven by weakening demand linked to high inflation, low consumer confidence, and a change in consumer behaviour. Service reliability has been at an all-time low. Obviously, shippers have built in higher safety stocks and shipped peak season cargo early to avoid shortages. But until demand improves, stabilisation would need to be driven by capacity management. And I go back to that sort of controlled decline and controlled capacity management. And as we see the port congestion easing, we believe that this will help it stabilise. We talk about dials moving from red to amber to green. We've seen the dials move now. And that, to some degree, will lead to a stabilisation of the market. However, to be clear, not all rates move at the same time. So if you're on a primary trade, you may have seen, our World Container Index showing a 58% down year-on-year trend on the Shanghai to Rotterdam rates. But, from rates from Rotterdam to New York, for example, there's still a 2% increase happened last week. So there will be fluctuations on a trade-by-trade basis. But if you're watching the dials and you're understanding what they mean, then hopefully you'll see hope on the horizon within the market in terms of stabilisation. But it does come down to how the capacity is managed by the carriers.
Very interesting. I'm going to move us on, if that's okay, Chantal, to some Q&A. So I definitely can't answer this first question because it will be the definition of talking my own book. The first question is essentially, if I can summarize, is around large shipping lines moving more and more into end-to-end. We've obviously seen that with CMA a while ago acquiring Seva and then them going on to do more in contract logistics. We've seen it with Maersk, obviously, with their several acquisitions. You could say to an extent we've recently seen it with both Hapag and MSC, although they might argue that was more one-off and they're more focused on still being the world's best shipping lines rather than going direct. To an extent, we've seen it with Costco as well, although to a much lesser extent. And obviously, this has triggered a lot of M&A as a result. The question really is, are these large ocean carriers ready, paraphrasing here, to handle these volumes directly with shippers? Are they well set up? And do we see a large migration of business going from forwarders to shipping lines? And then if I can build on that, as the rates normalize, does that trend, if it is a trend, does it continue next year? Because maybe a big part of the leverage was the rates that they were able to offer. So your thoughts on that would be much appreciated.
Yes. So I think the key one here is Maersk and their end-to-end solution. They've invested heavily in that. And what we've seen that last year, it was used as a leverage of, if you want to secure allocation with us, you pay the rates we want you to pay, but you have to use our end-to-end solutions. I would say the integration of that into shippers' systems has not been easy. It's not been smooth. They still struggle with last mile movements. So there's a lot of work to do. I feel that they may well be feeling slightly nervous about this now as a strategy as the rates start to fall. I don't think they expected the rates to fall as much as they have. So this is a great question. Some people have gone for it and some people haven't. Some people who went for it have not had great experiences of it and may well be looking to move back to the more traditional carrier role. Those who have had good experiences of it have definitely had to have the technology that works with their technologies. And that's been the sticking point to a lot of this. CMA and Seva have treated it slightly separately, so that has not been such a major issue. The CMA part has still been very much about the carrier, the ocean freight, etc. So I feel that it was a moment in time that a strategy and investment was decided to move forward with Maersk, but I feel that maybe it will be a struggle for them to get people's buy-in during a downturn.
So candidly, if you were advising clients next year and Maersk were offering this integrated service, obviously it will all come down to the end-to-end cost and the value and the technology and what it can drive. But is it something that you'd be advising clients to shy away from, given what you've heard, or a different piece of advice?
I think it would be have a discussion about what it is they want you to package together, understand how that would integrate with your operational systems, but also your IT systems, and do your due diligence around that. However, of course, still invite them to your bid for the ocean freight, because we know that latent capacity is coming into the market. As congestion eases, a lot of latent capacity that was hidden in the market will come back. So they're going to need you to help them fill that as well. So, it's a discussion, but it might not be a core decision criteria in 2023, which is why if you've made a lot of investment and you've asked your investors to do that for you, you might be feeling slightly nervous if you're sitting in a CEO's position at Maersk right now.
Thank you for that answer. There's a couple of different questions here as I go through them that's asking about normalizing. What does it mean? And 2019 versus 2015, and then also a question on do we predict more industrial action? And I'm going to group them together because I think actually there is always a risk that industrial action acts as a catalyst to not lead to normalization. So maybe you can give your views on what does normalization mean? Are we going to follow typical economic cycles? And how does further industrial action feed into this?
Industrial action is a disruptor. And disruptors happen at given moments in time, as you alluded to with the Suez Canal. In an ideal world, they're resolved in a fairly quick time, so that then the impact on the market is more operational rather than rate driven. We believe disruptors will continue to come in. Labour disputes are a key one. We've seen them in the UK. Have they impacted the rate offers? Probably not. It's been operational impacts. In terms of rate stabilisation, it goes back to this managed capacity and the managed decline. Clearly, there is a relationship between economic growth and the demand for containers and consumer products. We base our own forecasts on that. Any downgrade on GDP projections has an impact on our forecasts. They are being downgraded. However, because we believe the carriers will want to protect profit levels and we believe they will want to manage their capacity, we don't foresee rates falling to a pre-pandemic level, i.e. 2019. That's Drewry's view. Other consultants may have a different view, but this going back down to 2019 levels is not something that we are forecasting ourselves right now.
And do you feel, because there's another question that just came in asking, where do you expect Asia, Europe to go to? It's hard to tell because it's obviously moving very quickly. Are you able to share anything there?
Well, the question again about where rates will go is always one that's hard to answer. We know that rates are going to come down. We think they're likely to fall between 20 and 40%. Again, that will be dependent on trade, dependent on your relationship, dependent on who you're using. We know certain carriers, and if you have shippers on the line here, certain carriers will not entertain talking about reducing their rates right now. Some carriers are out there being proactive talking about it. So yeah, that's probably as far as I'm going to go, rather than give a rate level, a 20 to 40% decline.
And it's very difficult. And then there is one last question here, talking about the divergence that they're seeing across in the market right now with rate levels moving quite dramatically. What we've been seeing is that it really does depend on how full carriers are right now and how they feel about their position. I'm curious what you're seeing, but we do see quite a big deviation from some carriers but I think it's going to start to compress, but at least in the past month or two, which is probably quite a unique period in the economic cycle. But I think it will start to reconverge in terms of the dislocations that we're seeing on a rate level. Is that consistent with what you've seen?
I would agree with that. I think it's a little bit about who's blinking first right now. We know that certain large carriers are not moving, and we know on their rate fronts, and we know that others are. And I think it is totally reactionary. Carriers sometimes get focused on market share, get focused on volume, and then they forget about, the rate market. I think certain ones are more mindful of that. And I think you're absolutely right. We're in this sort of slightly strange period of flux, and with all the economic doom and gloom that's happening around the world, it's making everybody nervous. And we're getting a few sort of, shall we say, kick reactions to that.
Thank you so much for your time. The last thing that I'll say before leaving is this really does remind me a lot of what happened in 2008, 2009, 2010. And I remember CSAV really getting very excited about the market. And actually, in hindsight, that was all because of restocking. And so we'll speak about that later. But I think it's important for everyone on this call to think about, might we go through that cycle again? And therefore, again, it comes back to your point about shipper of choice, relationships, origin management and the value, but also navigating this market environment. So Chantal, thank you very much. And Helen, I'll hand it back over to you.
Thank you for tuning in to another episode of Freight to the Point. If you liked this week's episode, don't forget to like and subscribe to our podcast. And please do reach out to us on LinkedIn if you have any feedback or questions, or if you would like to suggest a future Freight to the Point episode. Thank you.